Don't invest in a business you don't understand. Wise words from the wise man, Warren Buffett. So before you invest your hard-earned money into companies making a beeline for the Lal Street, it's important to understand your company. Know your company. This is CNBC TV 18's latest offering, IPO KYC. 10 questions and all the information.
Honasa Consumer is not just Mamaearth. It's a house of brands. Started in 2016 with Mamaearth, it now has 6 brands. Mamaearth, Dermaco, Aqualogica, Ayuga. These 4 were homegrown. 2 of them were acquired, Be Blunt and Dr. Shades. The company has a revenue of 1,500 crore rupees as of FY23, growing from just 110 crore in FY20. The company reported a loss of 1,300 crore in FY21, a profit of 15 crore in FY22, a loss of 150 crore in FY23, and then a profit again in Q1 FY24. 40% of the company's revenues go into ad spends.
The 1,700 crore IPO, which is offered at a price band of 308 to 324 rupees per share, looks to value the company at a little over 10,400 crores. The company will have a fresh issue of 365 crores, and the remaining will be an offer for sale from some existing investors. The company is asking for valuations at nearly 100 times 1 year forward price to earnings. Should investors bite in or stay out? Let's know your company.
We have with us none other than Varun and Ghazal. We're talking about Mamaearth, Honasa, coming out with an IPO. So many things going through your mind. But everyone knows the company as Mamaearth. What does Honasa mean? And I see a Honasa tattoo on your hand as well, a mehndi tattoo.
A mehndi? Yes.
Yeah.
I was attending a wedding function and we had to get mehendis. So
And
what
you
was
knew
on my
the
mind came on my hand. But Honasa actually means honest, natural and safe. That's the first 3 words of each of the words that forms the name of our company.
For a lot of us, Honasa Consumer stands for Mamaearth. But it's so much more than that. It's a house of brands. You have 6 brands. So in just a few lines, can you tell us the business of your company?
So Honasa, like you said, is a house of brands. And now we have 5 more brands. We have the Dermaco, which is a brand based in scientific active ingredients for your skin concerns like acne, pigmentation. The brand has done phenomenally well in 3 years. It has clocked a revenue of almost, it's at an ARR of 300 crores. We also have Aqualogica, which is a brand based on deep hydration for your skin. And that brand has also grown phenomenally. It is at an ARR of 150 crores right now. And similarly, we have acquired 2 brands. All of them continue to grow very strongly. So yeah, 7 years, 7 brands now.
1,500 crore was your top line in FY23.
Yes.
80% came from Mamaearth.
Yes.
Can you give us the balance breakup of the other 5 brands?
So the other 5 brands, like Ghazal said, each one of them is growing disproportionately. And some of them were just 1 year old or 1.5 year old. And so I don't think it's fair to look at contributions. Right? But the fact that 3 of them are now more than 100 crores right? In just the last 3 years' time, right? In a space where you have not seen even larger companies being able to create such sizable brands in such short period of time, right? Does talk about our capabilities as an organization, as brand builders.
So if we had to basically simplify your business, you guys are brand builders. You'll make brands which stand for stuff. You'll get the products manufactured from licensed manufacturers, and then you'll sell it to the market, right?
Yeah.
Online and a little bit offline.
I would add 2 more things, right? I think, we genuinely believe in the power of beauty and personal care category in India. And we believe that is going to be one of the fastest growing categories in FMCG in India. And disposable incomes and women joining workforce is a mega trend for India, because of which that category is growing the fastest. I think our focus on innovation and R&D, and we genuinely believe that while a lot of brands were serving India, and nobody was crafting for Indians, and understanding our cultural nuances, knowing our beliefs that, we like Multani Mitti, we like Ubtan, we use turmeric at home. And how can you create products based on these ingredients, right, which consumers will love? Using our R&D, using our innovation is something that we have excelled in, right? And that's what consumers love us for.
Perfect. You spoke about disproportionate growth for your ancillary brands, but as a company itself, the last 3 or 4 year CAGR has been upwards of 80%. Obviously, it's on a low base, now 1,500 crores. At some point, the base catches up. The question is, what is a sustainable growth rate for you guys, say, 3 to 5 years down the line?
I think for us, what is going to be sort of, the desire and dream, and is to make sure that we continue to deliver better growths than the market, right? And continue to gain share. And so I think the aim will be to make sure that we outgrow the market and we continue to delight our consumers, right? By offering products that they really love.
And I think we are already seeing that, right? The way Mamaearth scaled up and the way we are now seeing a Dermaco take that same trajectory, on an Aqualogica, which is beating even the records of a Mamaearth and the Dermaco. The brands continue to scale really well and faster, and we've become more efficient in the process. And I think that's something that we are going to chase going forward.
Let's talk about the bottom line then, right? You had a loss in FY21, a profit in FY22, a loss again in FY23, and a profit in Q1 of FY24. So going ahead, is Honasa Consumer going to be a sustainable profit-making company?
So even if you look at the past, and if you remove exceptional items, and actually the company has been adjusted EBITDA positive. Right? We have, of course, improved our trajectory. Right? So from a last year adjusted EBITDA of about 3%, we have gone to about 7% about in quarter one of this year. And all of that is happening because when you scale up, and you see leverage starting to kick in. Right? Your marketing starts to become better, and you become more efficient. You need lesser marketing to reach out to the consumers because you have built awareness. Right? In our business of brand building, you need to first drive awareness. If people don't know what your brands stand for, why will they buy them? Right? So that's an investment that goes in. But as your brand scales up, right, the investment sort of starts reducing as a percentage, right? And which is what we are seeing. Right? And we hope that we will continue to demonstrate that efficiency as we scale in future as well.
You spoke right about the thing that was worrying me, that was marketing spends. You said that as you get scale, marketing spends as a percentage of sales do come down. For a company that does 70% plus gross margins, the EBITDA margins have been single digits. Why is that? Because when you were a 100 crore company, marketing was 40% of your sales. Now you're a 1,500 crore company, marketing was still 40% of your sales. Last quarter, you cut it down by 5 percentage points, and we saw that in your EBITDA. Immediately, your EBITDA came up by 5 percentage points as well. At what level does marketing as a percentage of sales start to reduce, stabilize, and when do we start seeing leverage? Because even at 35%, you all are 2-3 times the FMCG industry norm.
I would just like to say that this needs to be looked at as a journey of the last 7 years. This is a journey of building 6 brands at the same time. So while Mamaearth is 7 years old, the other brands are actually just 2 to 3 years old. Some are even younger, right? While this brand continues to grow and the leverage comes in, we are choosing to invest the money into building and scaling the younger brands that we have, right? And hence this ad spends and the percentage that you're talking about is actually a mix of, it's a sum of parts, right?
So you have a Mamaearth which is seen that leverage journey, right? But then you have 6 more brands which are much younger and have much higher percentage reinvestment. Right? Now, even with that sum, right, if we are able to go down, right, actually the efficiency journey is much steeper. Right? So is what we are
So
seeing.
what would the delta in terms of percentage of sales as advertising be for Mamaearth and all the other brands that you're investing in?
Of course, they're higher, right, by a decent margin because they're younger, but also take into account the growth factor. When you say that we have higher percentage reinvestments, and please also see we have significantly better growths than the industry. And we are continuing to gain share because that's what we want to do, right? We genuinely believe there is an opportunity out there for the taking. And we want to be that company which builds these brands and takes that share. And that's what we have been gunning for, and we've been able to do it. And that does require us, because we are competing with brands which might be 50 to 60 years old and already have that awareness. That does require us to drive that awareness, and we've been doing that. But like you rightly said, and it's a 70% gross margin business, right? So finally, as maturity sort of comes in, as things stabilize, it will flow through in the bottom line. We are just choosing to invest in growth.
So just explain the cost items for us. 70% gross margin, it trickles down to mid-single digit EBITDA margins. 40% goes for advertising. What are the other expenditure items for you, and which of them can be squeezed or can be used as margin levers? So we spoke about ads, but
Yeah.
the others.
So there's marketing, there is salaries, right?
That's how much?
There is OPEX,
Yeah.
right? About 10-odd%, right? There is OPEX, right? Which is rents and all the other expenses, right? There is channel spends, right? We believe that the largest leverage would still come from the A&P bucket, right? But all the other also ends up being generating leverage as you scale, right? Is what we've been seeing, as we have sort of started on that journey. And I think over years we will get to see that even more.
And adjusted EBITDA margins are 7%,
Yes.
right, in Q1. As the other younger brands achieve a steady state, what could be the normalized margins for Honasa Consumer, according to you?
Of course, they'll be better. Right?
They can only be
In
better.
double digit,
See,
I
I think the
teens.
right way to look at it, right, is that you see it, like you rightly said, from a gross margin perspective. And amongst, if you compare to the FMCG peer set, we have amongst the best gross margins. Right? So over time, ideally, that should lead to better EBITDA margins relatively as well, right? And that's what we would like to work towards
There's
over
no
the next
range
5 to
in
7
EBITDA
years.
margins?
Not
High
this
teens,
point of time, right?
mid-teens,
I think we will continue to get better. And why stop at that?
Why stop at that?
But teens.
Why stop at teens? We'll see how that goes. The online channel is where you started. You were probably India's first digital first emerging brand, competitive brand, so to say. And now you are looking at the offline channels as well. How are you looking at this mix changing going forward? And what are the challenges? Because for online spends, the customer acquisition costs have increased. For offline, you have these big giants who are already, have their ecosystem with the trade, etc. How do you look at this mix go, and what are the challenges that you face?
I think for us as a company, our focus has always been on consumers rather than channels. And you optimize where you can get your consumers from at that stage of life in the brand's journey, right? So for example, for Mamaearth, when we started out, actually the only option that was available for us was online, right? So it wasn't like we chose between online, offline, but of course, sitting at one place, having the ability to serve pan-India, getting the right early adopters, that channel made a lot of sense. Now, as the brand has scaled, what we are following is where is our next set of consumers, right? Offline still continues to be one of the largest channels, right? 85% of the purchases in the category still happen offline. And if the consumers are there, why would you force them to buy into another channel and not the channel of their choice? We as company, as a brand, believe that we need to be available at the right touch points where consumer wants to see us, and that's how the online, offline, or like we say now, the omni-channel strategy that we have is panning out for us. The next level of growth, we very strongly believe, will continue to come from offline because we've just started getting started.
So if you could give us a sense of what your current offline reach is and where do you intend to take it, say, a couple of years from now?
So, honestly, it again needs to be seen as a sum of parts, right? A Mamaearth is at a level where the next level of growth is coming from offline. And the younger brands are still seeing their growth coming from online because the consumer which we are targeting there, right, is still buying online. Right? So in case of Mamaearth, we are present in more than about 120,000 stores right now, right, with our lead categories. Right? But the universe is far and wide, and we all know that. Right? We are continuing to double down on on executing the strategy that we had put in place, right? And we are very confident that that strategy will continue to bear results for us in terms of driving growth for that brand there. Right?
What are your hero products? I'm sure both of us have used the onion hair shampoo and we have the Upton face wash. So those two, I presume, would be a large chunk of your revenues?
Yes, for Mamaearth, they are hero products, right? And
How
they
big would
continue
they be,
to grow.
according to you?
Both of them put together would be more than 15%, close to that range of more. So in the tune of 100 crores, right, in terms of individually.
And that's the issue as well, right? Because when you have a hero product which is available online, 95% of the sales of that product by competitors happens offline. You have a Marico, you have a Hindustan Unilever, you have a bunch of startups which are looking at the success of these products, and they've come out with similar products.
Yeah.
You see multiple options for Uptons and onion hair oil, hair shampoo, everything onion. How do you compete with so many people, the large players and the newly funded, equally aggressive new age players?
Two things. One, I think first mover advantage is rewarded by consumers. The fact that we were the first, we were the ones who have built strongest association with these, right? And consumers do remember us for these ingredients. Two, quality. And I think we do bring a certain level of quality to the table, right? Which is differentiated, which is better, right? And consumers do recognize that, and because of which these products, even after all action that have happened, continue to demonstrate leadership in their ingredient.
You started off as a baby products company, and then you all, evolved, morphed into a larger FMCG giant that you are today. What are the other white spaces that you are looking at? 3 of them, if you'd like to tell us.
So for us as a company, I think all of it starts with consumers and trying to understand what is it that they're looking for.
So what is it that consumers are looking, which you haven't, which you don't have?
So I think what consumers were looking for is what we have serviced
So
them
far.
with the 6 brand portfolio that we have. And for us, it's all about that. It's about understanding their needs.
But are
It's
there any
about-
white spaces?
There will be. We will continue to look the way we have come up with a Dermaco, which was the first brand to start talking about active ingredients in the Indian market, serving it directly to the consumers. The way we brought Aqualogica, deep hydration-based brand, understanding your weather, your skin, understanding India and Indian people and Indian cultural nuances through that as well. Similarly, I think we will continue to look for those white spaces. We have an extensive consumer listening tool that we have built in-house. It's a technology tool which helps us connect with consumers on a daily basis, ask them the right kind of questions, ask them what is on their mind, what are they looking for, probably get 1,500 to 2,000 answers in just 24 hours.
What are the spaces which you think right now are a no-go for you?
So we genuinely believe beauty and personal care is what we are really good at. And as a corporate, as an organization, we have built strong R&D strengths, innovation strengths, understanding of the consumer's skin, hair, habits, right? And that's the category that we will continue to build. Right? Our entire focus will be on winning in the beauty and personal care space. Right? Anything outside of that, right, is avoidable at this point of time.
So no F&B. The onion hair oil does not translate into onion chips?
No, not
or anything
really.
of that sort, right?
No plan.
No
Beauty
F&B.
and personal care is the focus area for us.
Perfect. Now let's talk about the most important thing, the valuation. Well, there were a lot of murmurs before the IPO about some obnoxious numbers and all of that. Now everything is there for everyone to see. At the price that you are asking for from investors, the company would be valued a little over 10,000 crores. The revenues that you did last year was 1,500 crores. Presuming we annualize the net profit of the first quarter, you're still asking for 100 times 1 year forward price to earnings. This at a time when the other FMCG companies, which are expensive, trading upwards of 50, 55, at best, the most expensive is 65. What makes you think that, there is value left on the table?
See, firstly, I think the process of valuation and how do you arrive at some of this is a process where we met almost over 100 investors over the last 1.5 months. And through the conversations and the modeling that they have done, is how these numbers get arrived at. And it's not just a picture of your current business, right? But more importantly, a view on how the business will shape in future as well that they have. Right? Now, keeping that in mind, right, our view is the right sort of comparisons, etc., for this company at this point of time, because it's not at a stable profitability profile. Right? It's still improving, right? And it's a faster growing company relative to the peers that you're talking about. Right? And hence, some of those metrics might not be the right comparisons. Right? EV by gross margins or EV by revenues might be better comparisons to look at. Right? And if you look at those comparisons, we'd actually be at a discount to the peers that you're referring to. And over time, that would of course continue.
EV by
to evolve.
revenue growth, yes, you are comparable.
Yes.
EV by gross margins, like you said, because 71% gross margins, but the minute it goes to EV by EBITDA or price to earnings, it's
That's a
the
capital
marketing.
allocation choice, right?
Yes,
That's a capital
so-
allocation choice to drive better growth, right? And that's what we are choosing to sort of invest in to grow faster.
So as per you, there is value left on the table. Is that what you'd say?
See, I would just say that we're still 7 years young. We're just getting started. I think for the both of us, we are in this for the longer term, right? We are so excited about the opportunity that we see, about the growth of the company, about what we are doing, the consumer love that we are getting, that this is just a part of the process. I think we should look at the bigger picture. We should look at what this company will achieve in future and just focus on that.
We will do that. I mean, just parting thoughts. You all started at a time where D2C was just about growing. Thereafter, there was this massive growth because of COVID. There was also a massive entry of people coming in. Valuations were surging. Now there's been a bit of a lull. There has been a funding winter, so to say. People are normalizing their habits in terms of consumption online and offline. This journey, what has this taught you about business, life, and valuations in general?
I would say what it has taught me is, one, the power of dreaming, and with the right kind of focus, achieving big is how I would like to summarize what we have done as a set of middle-class parents who just decided to dream and execute, and with the right kind of focus just achieve that. And for me, it is a journey of doing what you love. And if you really are into what you're building, you will, everything else I think is just a part of the process. The metrics, we are still evolving, all of that will continue to happen. But if the intent is right, if the past growth says something about us as people, and we have so many people who have associated with us, beautiful partners who have helped us in this journey, they would also say something about our ethics and our way of doing business, right? I just feel that that's the core, and that's what we are going to take forward from here.
Varun, Ghazal, it's been an incredible journey. Congratulations, and thank you very much for speaking with CNBC TV 18.
Thank you so much for having us.
Thank you.
Thank you.